Hi everyone, welcome to this second edition of our revision program, our subject being financial management. In the previous edition, we talked about consolidated financial statements, preparation of consolidated accounts, and also we discussed at length about step acquisitions and disposals, and also we talked about financial instruments. So today I'm going to focus on some more accounting standards followed by the report writing area. The initial one that I'm going to focus on is going to be IAS 19. IAS 19 is about pension benefits, another area that is quite easy. It's a very easy area, just a couple of calculations to remember, and if you get it right, you can get some easy marks at the examination. According to IAS 19 pension benefits, there are two types of pension benefits schemes that we identify. We have the defined benefit schemes, and then we have the defined contribution schemes. Now, what is the difference between a defined benefit and a defined contribution? Now, take a look at the EPF scheme that we have in Sri Lanka. In the EPF scheme, you know exactly what percentage of your salary is being taken out. 8% is taken out. Your employer will contribute 12%. So you know that every month this amount is remitted to your EPF account. But the problem is there is no guarantee that you are going to receive a given amount when you retire. Whatever the balance that is there, you will have to accept it, and you can't say this is what you are going to get. That sort of a scheme is called a defined contribution scheme. Only thing defined, only thing certain there is the contribution. But in a defined benefit scheme, it is the benefit that is being defined. Take a look at something like the gratuity. The gratuity scheme in Sri Lanka says that if you work for more than 5 years, you are being guaranteed half a month's salary for every year you work, and half a month's salary being the final salary where you take it at 50% and give it for each year. So when you do a calculation like that, there are a lot of uncertainties because employees joining the organization, you don't know how many of employees are going to be there for 5 years. Because if someone joins and leaves in another 1 or 2 years, they are not entitled for this gratuity. But if someone stays there for more than 5 years, it could be 5 years, 10 years, it can go even up to 15, 20 years. Then they are entitled for a gratuity payment. And the final salary is another thing that we can't predict. We know how much of a salary that he is joining the organization, but we can't say how his increments are going to be, what his final salary is going to be. Because of that, these defined benefit payment calculations will take a lot of assumptions in when you perform the accounting. There are lots of assumptions we make in calculating for defined benefit schemes. As you can see in the screen, we consider 3 different items when we calculate the expense that we recognize in the income statement. The income statement expense will comprise of the current service cost, the past service cost, the finance cost, all these items put together, and then you deduct whatever the return on assets you get, the final amount being recognized as an expense. In the statement of financial position, it's the difference between the pension asset and the pension liability. The net asset, net liability will be recognized in the SOFP. Recognition of actuarial gains and losses. Actuarial gains or losses arising will be a part of other comprehensive income, and that will be recognized under the other comprehensive income section in the statement of comprehensive income. Let's see how actuarial gains and losses are being calculated. Now the rule is when it comes to plan assets must be measured at fair value. The fair value at the beginning, fair value at the end, both these figures will be made available to you at the exam. Actually, most of the things that are there in this calculation is available in the question. It's up to you to pick the relevant items and put them in the right place. If you can pick the items and put them in the right place, if you know whether to add it or deduct it, guaranteed marks are there for you. So the items that will come under plan assets calculation will be the balance at the beginning, return on assets, which is opening balance at whatever the rate of return, contributions made by the employer to the plan, which will be added, any benefits paid. It is out of the assets the benefits are getting paid to the employees, the benefits will get deducted, and you compare all these things with the balance that you are given at the end of the period. Any difference will represent an actuarial gain or loss on plan assets. While you calculate actuarial gain on loss on plan assets, a similar calculation needs to be performed for the plan liabilities. You start with your balance at the beginning, which is given to you at the exam, and you reconcile this balance to get the closing balance. In this calculation, you will be considering your current service cost, your past service cost, any interest cost, the benefits paid will get deducted, and these balances will be then reconciled with the closing balance, where any difference will be taken as an actuarial gain or a loss. Both these actuarial gains or losses arising on plan assets and plan liabilities will be taken into other comprehensive income, and that's how the calculation is going to work out. Remember, when it comes to actuarial gains and losses, you got to recognize them separately. Don't ever add them together and show it as a single figure. Under other comprehensive income, it's always better to show them separately and then take in the total later on. That's IAS 19 for you. We are moving into the next standard, another easy one. This is going to be IFRS 2 share-based payments. Share-based payments can be divided into two categories: equity settled and cash settled. Equity settled means if the employee is going to remain within the company for a given time period, he will be allotted with shares of the company. Cash settled is where if the employee is going to be within the company for a given time period, he will not get some shares, but rather he will get a cash payment, but the cash payment will depend on the share price of the company. It's actually a good way of retaining employees, because the employees will feel that if I am going to work in this company for X number of years, I will be becoming a shareholder of this company. If I am going to work in this company and if I contribute towards the success of the company, the value of the shares are going to go up, so the value of the shares I'm going to get is going to be high. And if you are getting a cash payment, obviously the share price going up will indirectly benefit the employee. He will be getting a higher cash payment at that point of time. At the examination, the examiner will never tell you whether it's equity settled or cash settled. The accounting is different for the two categories. So how to figure out whether this is equity settled or cash settled? You got to go for the term, got to look at the term, and the term will tell you whether this is equity settled or cash settled. If you have a scheme that is known as a share option scheme, a share option scheme is about equity settled base payments. If you have a system where the method is identified as a share appreciation, right, then this is where a cash payment is happening. So let's see the two categories, cash settled and equity settled. In cash settled, employees are rewarded with a cash payment by referring to the share price. In equity settled, employees are rewarded with an equity instrument. Equity instrument, the shares are being given to the employee at the end of the given time period. Let's see how the accounting is going to happen. If it is cash settled, it is measured at fair value at each reporting date. Look at the share price, take the share price and calculate the fair value at the date of reporting. You take the fair value, compare it with whatever the opening balances you have got, and then recognize the amount that should go into your income statement. Any amount that goes into the income statement will be debited to your income statement, and the corresponding amount will be charged to the liability. So debit your income statement, the expense will be recorded as by debiting the income statement and crediting the liability account. Equity settled is also done in the same way, but with a slight difference. When cash settled is measured at fair value at the reporting date, equity settled is measured at fair value but considering the value at the grant date. Now what is grant date? The grant date is the day you announce that such a scheme is in place. So at the grant date you measure the fair value, use this fair value for accounting at the reporting date. Take the fair value at the grant date. Remember at the end of each accounting period you have to figure out how many employees are entitled, because there could be staff leaving, reducing the number of employees entitled. Calculate the value of the scheme and then compute your expense. The expense will be debited to your income statement, with the corresponding entry will be charged to equity. So the difference between equity settled and cash settled is, in cash settled you will recognize a liability, in equity settled you recognize an equity component. Both will recognize an expense, but the way in which you do the calculation is a little different. Cash settled is fair value at the reporting date, and then equity settled, you take the fair value at the grant date. That's how the calculation are going to be carried out. Another standard that can be quite important at the examination, IAS 18 revenue recognition, but this is not something that is tested often. It's not tested alone. It is tested along with substance over form. So let's see what IAS 18 revenue recognition is all about. The standard specifies several conditions to be followed when goods are being sold, when a company is selling goods. There are 5 conditions mentioned in the standard. Significant risks and rewards of ownership must be transferred to the buyer. It is reasonably certain that the buyer will pay for the goods. You must have a reliable estimate in terms of cost and your revenue, and you should not have, the seller should not have any influence over the goods sold. Substance over form talks about commercial reality. Transactions to be accounted based on the commercial reality rather than their legal aspect. Consideration should be given to the whole sequence of transactions instead of the transaction in isolation. Sequence of events, whole transaction. Looking at the substance, the commercial reality, rather than the legal form. What is this all about? Now, we have not really used this concept before in our studies, but even in FO, financial operations, this concept is practiced. Recall IAS 17, accounting for finance leases. In a lease arrangement, there are 2 parties. You have the lessor and the lessee. The lessee is the one who will be acquiring the asset, who will be using the asset, who will be maintaining the asset, ultimately who will be keeping the asset within the organization. But then there is the lessor. The lessor is the one who will be providing money to acquire the asset. The finance provider, we call him. The finance provider will remain the legal owner until the lease payments are fully completed. Only when the lease payments are being fully completed, the legal ownership will be transferred to the lessee. So if you recall the accounting, how did we do the accounting? Even though the lessor is the legal owner, the asset was recognized in the books of lessee. Lessee did not have any ownership, but continued to experience risks and rewards of ownership. That is what we mean by the commercial reality. Who is enjoying the benefits? Who is exposed to the risks? This is the party who has to recognize the asset. That is what we mean by substance over form. So in IAS 17 we have discussed, when it comes to recognition, the lessor will recognize the amount that is receivable in the form of the lease receivable, the lease that he's given. The lessee will recognize so many things in the financial statements. The liability will be recognized, the lease liability. Any interest will be accounted in the income statement. Then the lessor will also recognize, the lessee will also recognize the asset in the financial statements. Depreciation will be accounted. All these things will be accounted by the lessee himself. So that's substance over form. The areas that can be tested under substance over form will include consignment inventory, debt factoring, sale and repurchase arrangements. Now if you look at sale and repurchase agreements, that is where you will sell your asset, but with a condition that the asset will be purchased back after some time. The transaction looks as if you are selling something, but there is a condition that you are going to buy it back after some time. So if you are going to buy it back after some time, that doesn't mean that you are really selling it. You are keeping your asset as a security and obtaining some sort of funding. So when it comes to sale and repurchase agreements, we can't really consider that this is a sale and we can't dispose the asset. It's actually you're keeping your asset as a security and obtaining some sort of a facility. So the facility you get, it will be referred to as disposal proceeds, but you have to recognize that as a liability. Asset should never be de-recognized. Asset should be there in your financial statements, and you should continue to charge depreciation in your accounting records. So that's how sale and repurchase agreements will work out. Let's go for a break and then continue with the rest of the discussion. Welcome back. Before the break, we were talking about substance over form and how substance over form is affecting the financial statements. We talked about sale and repurchase agreements, and now we are going to talk about the second one, the consignment inventory section. Consignment inventory has been tested a couple of times, and both these questions have been the same nature. It has been a car dealership where the manufacturer is giving some vehicles to the car dealer, and the question is all about who should be recognizing the vehicles in its financial statements. Is it the manufacturer or is it the dealer? First of all, let's get an understanding about what is exactly meant by consignment inventory. Consignment inventory or consignment stock is all about inventory that is legally owned by one party but is held by another party. In a typical vehicle dealership, the vehicle manufacturer will give some vehicles to the vehicle dealer so that he can use these vehicles for display purposes, to show them to the customers, and then encourage a sale for promotional purposes for the customers to come and have a look, and even to sell it if some sort of an urgent sale comes up. But ultimately, got to identify who is the real owner of this inventory. The real owner is the legal owner. The legal ownership is with the manufacturer. So the real owner from a legal perspective is the manufacturer. But the point is, in substance over form, we don't really look at the legal aspect of it, we look at the commercial reality. The commercial reality indicates that when it comes to recognizing consignment inventory, we have to look at who is exposed to the greatest risk associated with inventory. Now, one might have a question, what is this greatest risk in inventory? The worst thing that can ever happen with inventory is the inventory becoming obsolete. Obsolete means you really can't do anything with that, you can't sell it to anyone, you just have to throw it away. So if inventory becomes obsolete, who is bearing the cost of it? Is it the manufacturer or is it the dealer? The party who is exposed to the risk of obsolescence is the one that you should recognize the inventory in the financial statements. So it says here, inventory which is legally owned by one party, held by another party, inventory should be recognized by the party who bear the risk of obsolete inventory. Remember, in a scenario, you might find both parties associated in this transaction exposed to various types of risks. But what you have to look at is the worst possible thing that can happen. That is the risk of obsolescence. The next scenario is debt factoring. Debt factoring has never been tested, so you never know. It could be tested in this final examination held in November 2004 under the current syllabus. What is debt factoring? Debt factoring is used by companies so that they can give credit to their customers, and at the same time they don't have to suffer in terms of managing their working capital because the factoring company will provide them with some money. Now the question is, are we really selling our debtors or are we keeping our debtors as a security and getting some sort of a facility? What do you mean by selling our debtors? Selling the debtors would mean that you are no longer responsible for your debtors. The factoring company will take care of that. They will do the collection, they will be chasing the customers for money, and also more importantly, they will be exposed to the risk of bad debt. But if you're just keeping the debtors as a security, you're not really selling your debtors, you're just showing your debtors or keeping the asset as a security to obtain some sort of financing. So the two forms of debt factoring, as you can see, is purchase and non-recourse. Let's look at purchase. Purchase is all about company continues to suffer the risk of bad debt. That means you're really not selling your debtors, you're just keeping them as a security to obtain some form of funding. It's a financing arrangement, therefore the money you received should be debited to your cash and then credited to your loan account. But if you are going for the other option, non-recourse, that means the debt factor is bearing the burden of bad debt. You're really selling your debtors here, you're no longer responsible for your debtors in this particular scenario. So this is all about selling your receivables, where you debit your cash and credit your receivables. No longer responsible for bad debt, that's the end of the story. So that's consignment, inventory and debt factoring. We discussed about sale and repurchase agreements in the previous discussion. So when it comes to financial management, we are going to focus on one more area, and that is going to be a very important area because of the weightage in the syllabus. 35%, 25 mark question as well as a 10 mark question. This is report writing. Ratio analysis is something that you have discussed even at the foundation level. So here at the management level, you're not really expected to do ratio calculations as such, but you're rather given more marks for interpreting your ratios. Yes, there are some marks available for the calculation, but majority of the marks are available for the report writing or the content of your answer. Now, this is a big problem to the Sri Lankan students. It's because it involves a lot of writing, and by nature we don't like writing. However, in order to get through this paper, I see this area as one of the most easiest areas. If you know your ratios, if you can put a couple of pages together with some quality points, you surely will be able to get good marks, and that mark will help you to pass this examination. So let's first identify our ratios. I'm not going to talk about all the ratios that we have. I'm going to only talk about the relevant, the significant ratios. So looking at the performance, we have gross profit margin, a key ratio, very important one. Operating profit margin, and then you can also use your operating expenses as a percentage of the turnover. ROCE can be calculated, where ROCE can be further divided. You can divide it as operating profit margin and then the asset turnover, and also you have your return on equity. On position, you can talk about your liquidity, current ratio or acid test, and then you can relate your acid test and the current ratio, the liquidity side of things, into your activities. That is your inventory, receivable and payable days, if there are big changes that exist. Also you can talk about your gearing backed up by the interest cover. Gearing and interest cover, they have a relationship. Looking at the calculations, first up we have the ROCE, where the calculation will be operating profit divided by capital employed, taken as a percentage. Now, how is this capital employed being calculated? Now, capital employed is all about the entire capital that is available for you, primarily your debt and your equity. These are the two forms of capital available for your organization. So you use these figures, your debt figures as well as your equity figures, in your calculation. Now remember, some scenarios, some questions will feature overdrafts appearing. There's always a doubt whether an overdraft is to be considered in this calculation, or are we to ignore it. The understanding is as such: if the overdraft is used as a short-term measurement, there's nothing to worry, don't have to consider it. But if you use the overdraft constantly, that means if the overdraft is there as a current liability in the current year as well as in the previous year, then that's a part of financing, so you've got to take it into your calculation. So the calculation will be ordinary share capital, that is capital employed, ordinary share capital, any share premium, revaluation reserves, accumulated profits, other reserves, NCI, preference share capital, long-term borrowings, provisions, deferred tax balances, short-term borrowings, that is if it is lasting for more than 1 year, that's the bank overdraft, and minus any investments. They will be your capital employed. You take it into your calculation and calculate the ROCE. ROE is all about return on equity. You take the profit before tax divided by equity. Now what is equity? Equity is all about your capital and reserves. So that will include your normal share capital, your share premium, and whatever the reserves you have. So it says, when dealing with consolidated statements, remember profit before tax belongs to both parent and NCI. If it is consolidated income statement, it is the profit that ultimately gets divided between parent and NCI. So when you calculate your ROE, you got to consider your non-controlling interest. It's not just your share capital and the reserves, capital, reserves plus the non-controlling interest. We'll go for a break and then continue with the rest of the discussion. Welcome back. When you are analyzing performance and position of an organization, it's very important to identify the relationship between ratios. While you can calculate ratios in isolation, if you can bring some relationship between these ratios together, it will definitely add value to your answer. Now, one ratio that you can relate with a couple of other ratios is your ROCE. Now, ROCE is, if you look at the definition of ROCE, it's all about explaining your overall profitability. Overall profitability is actually a resultant of a couple of things. It's about your profitability, your performance, and then your efficiency side of things. So ROCE can be further broken down into your efficiency side of things and your performance side of things. So let's see how the ROCE can be divided into its efficiency factor and the performance factor. You can see on the screen how the calculation can be divided. ROCE, we can divide it as operating profit margin multiplied by the asset turnover. If you go back to the ROCE calculation, it's operating profit divided by capital employed. When we look at operating profit margin, that's operating profit divided by turnover, whereas your asset turnover is your turnover divided by capital employed. Because the turnover is the common factor in both these calculations, ultimately the resultant will give you the ROCE of the organization. But when you look at the two calculations in isolation, operating profit margin indicates the profitability side of things, the performance side of things, whereas the asset turnover talks about how efficiently you have used your assets. So that's the relationship of profit margin, operating profit margin, and asset turnover with the ROCE. Another ratio is gearing, a very important ratio, an essential ratio. I would say every calculation must have the gearing in the discussion. In the discussion it must be there because it talks about the capital structure of the organization. Gearing, you can calculate it in two ways. Either you go for the traditional gearing ratio where you take debt upon debt plus equity, or you go for the modern one where you divide debt by equity and take the percentage. Remember, when you do the calculations, always indicate the method of calculation, whether you do debt plus equity or whether you just do debt upon equity, because the examiner or the person who's evaluating your answer script must know what method that you have adopted. So debt upon debt plus equity, debt is long-term and short-term borrowings. Both will have to be there in your calculation. Sometimes we have comparisons to be done internationally, where two organizations are there in different countries. You are supposed to compare the two organizations. In such situations, you might have to compare interest rates. Now, how to get an understanding about the interest rate? Interest rate can be approximated. You can calculate the approximate interest rate by using the finance cost and the debt factor for the organization. Take the finance cost, divide it by debt, and take it at the percentage to get your debt element, the interest element. Tax rates, if it is required, again, different countries, you might have to compare tax rates. Two investments operating in different countries. You take the tax figure, income tax expense, and then the profit before tax. Remember, these are not the exact rates, but they will give you approximate measurements where you can use these measurements in your interpretations. Right. Then comes the problematic one, writing the report. Most students, as I said earlier, find it quite uncomfortable because of lack of preparation. If you ask them the question, how many reports have you written? Sometimes students go to the examination without even writing a single report on their own. It's very important that you go to the examination well prepared. And you've got to write at least 5-6 reports minimum. So make sure that with the remaining time available, you're getting closer to the examination, but take some time to write at least 5 or 6 reports. Check your reports with your examiner's answer and compare and contrast. Compare your answers and see whether the quality of your answer is the same quality that the examiner is expecting. You should never be in a situation where you go to the examination and write your very first report. That is not the place to practice. You have to practice your questions before you go to the exam, and a well-practiced student will definitely have an advantage over and above one that who has not practiced. So how to write the report? I would like to introduce a guideline that you can use even for your own report. This guideline will tell you how you should be writing your report at the examination. Remember, the question is worth 25 marks. Usually there are two components in the question, part A and part B. Part A is for the report. Part B, they will ask for something else, maybe for limitations or what additional information you need. So that's part B. Be prepared to answer for part B. Sometimes students simply forget part B. They don't answer part B, or they don't have enough time to answer the second part of the question. The first part of the question, 20 marks usually, divided into two, 8 marks and 12 marks. 8 marks are there for the calculation, that is the maximum number of marks available. 12 marks are there for the writing part. So remember, most of the marks are available for writing the report, not for the calculations. Now when I talk about the calculations, there are several things that you need to remember. You should never do the calculations within the report. The calculations must be after the report. It should be in an appendix, and you got to indicate the methods of calculations. You can't just do the calculation on your calculator and put the figure there. You have to do the calculation in full, showing various figures that you have taken into the calculation with all the workings there, and even the narration, how the calculation has been arrived at. You got to fully write your formulas and perform a full calculation in order to get the full marks. Remember, out of the 8 marks, for you to get at least 1 mark, you have to have the ratios correct in both years. If one year's ratio is wrong, the second year is right, you won't be getting any marks. Got to have correct ratios in both accounting periods. How many ratios should we calculate? That's the other question. There are so many ratios that are being taught, but we can't be calculating all the ratios that are available. We got to be selective. We have to use the ratios that are relevant for our answer. Usually it's about performance and position that we have to talk about. So select ratios that will help you to interpret your answer. Have a good distribution between position and performance. Don't be biased towards one side of the discussion. So it says approximately 8 marks are available for the calculations. That means there are 12 marks for the writing part. 1 mark will be awarded for a relevant point. Each relevant point you make, you'll be getting 1 mark. That means you should be having at least 4 to 5 points, well explained, each for performance and financial position. That's where you can attract majority of the marks. If a report is required, remember report format is needed only if they ask for a report. The last time examination, May 2014, they asked for an email. So the format should be in line with what they're asking for. A report has to be written if a report format is asked for. Got to follow the report format. Don't go and write lengthy introductions, but just couple of sentences introducing what you're doing will be quite handy. You can start by putting up the format. The format, as you can see, is going to have 4 elements. 2 from subject date. 2 is the recipient, from is what you are, who you are in the organization. The subject and the date is essential. Then you got to leave 2 or 3 pages blank so that you can come to the report later on after the calculations are being completed. Leave approximately 2 to 3 pages and proceed with the calculations in an appendix. Do not, never start the report until the calculations are done. You got to do the calculations first, and then you have to start with your report content. Normally, a common mistake that is undertaken by most of the students is they write conflicting points. In one place they write good about the company, and then you use the same ratio to talk about the bad of the company. So that is not something that you should be doing. Conflicting points are not going to attract any marks for you. Then use headers, use headings to link the requirement to your final answer. For example, have a section for financial performance, financial position, and have a section for recommendations if it is required. This is quite easy for the examiner also when you break it down into performance, position, and recommendations. For every point you make, you got to start it in a new paragraph. Don't have lengthy paragraphs, don't have big paragraphs. Small paragraphs, very nicely presented, will be very good on the eye. Read the background information carefully. Whatever the background information they give before they start the financial statements, you got to use it carefully. Read it very carefully, because they will be playing a vital role in forming your content in the answer. We'll go for a break and come back with the final edition of this discussion. Welcome back. So here you can see a general sequence as to how the body of your report should look like. I've broken this down into various paragraphs indicating what should go into each paragraph. So you can use the same guideline in documenting your report as well. The first paragraph is all about commenting on the size of the firm, any growth in revenue, the profitability, and also you can bring the gross profit margin into the discussion. In the second paragraph, talk about the operating profit margin, operating expenses, admin expenses, that is admin expenses and distribution expenses. That's your second paragraph. In the third paragraph, talk about the ROCE, operating profit margin and asset turnover. We talked about operating profit margin in the second paragraph. In ROCE, we are talking about ROCE and linking it with operating profit margin and the asset turnover. In the fourth paragraph, you can talk about other profitability elements. For example, an investment in an associate. If an associate has been acquired during the year, how it has contributed towards the profitability. Special scenarios like that can be discussed in the fourth paragraph. Fifth paragraph, we move into the financial position, talk about the current ratio, acid test, and then any cash balances. Remember, if you want to talk about liquidity, one of the main things that you have to focus is the bank balance or the cash and cash equivalent balance. Before you do your ratio calculations, by looking at the cash and cash equivalents, you can see whether they are having a positive cash balance or a negative cash balance. That indicates that there is a liquidity problem in the company. Sixth paragraph, we look at the liquidity further by looking at the activities of the organization, trade receivables, trade payables, and the inventory. Seventh one, it's about gearing and interest cover, and then getting the interest percentage if it is needed. And then the eighth paragraph is for any other comments, including whatever the comments that the chairman has made using the background information. You can take that. And finally, the conclusion. And if they are asking for a recommendation, you got to provide the recommendation as well. You can't leave it open-ended. If a recommendation is asked, you got to provide the recommendation in your answer. Right. Here I have picked up a question from September 2011. September 2011, question number 7. Now, I'm not going to really look at the financial statements here, but what I'm going to look at is the statement the chairman has provided in with regard to this particular organization. And I'm going to I'm going to show you how the statement provided by the chairman can be used in creating a quite good answer for the examination. It says LKJ has expanded during the last year and from 1st of October 2010 has been supplying a new range of products, some of which are simply cheaper versions of existing products, some of which are completely new. This has resulted in LKJ increasing its market share and creating a more mixed customer base. Now, a couple of sentences, but from these two sentences alone, we can come up with the following thought process. The first one, the chairman is saying LKJ has expanded. So if LKJ has expanded, the first question is, what has happened to the revenue? Has the revenue increased? Has the profits increased? How can we figure it out? We can look at the growth in revenue, we can look at the growth in profits. Now for a company to expand, there has to be some form of financing. How has the growth been financed? Have they borrowed anything new? How is the gearing looking like? And chairman also says that there had been a new range of products. Has the sales mix changed? Are we selling cheap products now? Are we selling high price products? And how is our gross profit margin is looking like? Are we losing on the margin? Are we undercutting the price? Are we selling at a premium price? You can figure it out by looking at the gross margin. Cheaper versions have come up. That's what the chairman is saying. Cheaper versions may be at lower prices. That means you are reducing your profit margin. You are losing the profit margin. Again, the gross profit margin will help you to understand it. And a mixed customer base. Mixed customer base would indicate that you have all types of customers. Are we suffering in terms of our liquidity? Are we giving them too much of credit? What is the impact on the receivables? You can take it by looking at the receivable days. So using the figures, I've done the calculation. So here are the details I've got. The gross profit margin is 21.7, 25.6. So you can see there's a drop from previous year to current year. Maybe an impact on the cheaper versions coming in, reducing the margin that you're having. Gearing ratio has also increased, 5.4 to 13.4. They have said that they have expanded, so that means there have been some form of financing coming in. Receivable days have also gone up, 47 to 65 days. Let's see how we can document it in our report. Initially, looking at the financial performance, the statements of comprehensive income shows that LKJ's revenue has increased substantially and its profit has doubled from last year. This is because of the firm's expansion, and it indicates an improvement in financial performance. But the gross profit margin has fallen, which is probably the result of lower prices on the cheaper versions of LKJ's products. They mentioned that they are going for lower prices, cheaper versions are there, which means that they are going to lose on their profit margin. The new products will have altered the sales mix, which will have also affected the gross margin. In particular, the firm may be selling these items at a discount to establish them in the market. You're undercutting the price so that you can establish your market share. Talking about financial performance. Receivable days have increased significantly. We saw earlier, receivable days have come up from 47 to 65 days. This is probably a result of a more mixed customer base. The company may also have deliberately offered extended credit terms in order to attract more customers and increase the market share. We see that sometimes companies do provide extended credit facility so that they can attract the customers, so that the market can be acquired, market can be established as a result. LKJ's gearing ratio has increased, but seems to still be at a very moderate level. 5.6 to 13.4, yes, it has increased more than double, but still you can see most of the funding is from equity. It's not a heavy gearing ratio. Both debt and equity financing have been raised to fund the expansion. Long-term borrowings have more than tripled rather, but given the moderate level of gearing and increased profits, this does not appear to be the cause of concern. So you can see how a small paragraph, couple of sentences given by the chairman has been elaborated by the use of ratios. Remember, rather than bringing points from outside, it's always better to use the points that are there in the question. Use the points there in the question because that is relevant to your scenario. Using these points, you can expand your answer, and a well-explained answer will help you to get more marks at the examination. Right, so with that we have come to the end of this revision program. Remember, when you are actually at the examination, it's very important to go with a clear mindset and a clear strategy to ensure that you pass the exam. You have 3 hours of writing, 20 minutes of reading time. Use the reading time wisely. Make sure you have a good plan of action for the 3 hours. I always suggest to my students that within the reading time, you have to pick the questions. Remember, there is no choice of questions. You got to identify the easier questions. If I'm looking at a paper, I would always say, go for the question with IAS 19, IFRS 2. It's a very easy question. There is a console question in section A, which is quite straightforward. And there is a financial instrument question also, which is quite straightforward, manageable. Look at section A, figure out the easy questions. Pick the 2 questions that you are most comfortable with. And within your question paper itself, you can scribble. You can't use your calculator, but you can scribble whatever you want to note down. Write down your answer and write down your answers in your question paper itself. So that when the paper is given to you for writing, you can always bring these answers into your answer script, and within a very quick time, 10-15 minutes, you can complete 2 questions. If you can complete within 10-15 minutes, if you can complete a couple of questions, that means you have enough and more time to complete the rest. It's all about confidence. If you are getting those first 2 questions out of the way as soon as possible, you will be able to succeed the examination. So thank you very much for joining with me for this revision program. Wish you all the best for the forthcoming examinations. Thank you once again.